All right, good evening, everyone. Welcome to the Hurley Investments Market View Commentary for Tuesday, the 6th of September. I'm going to share a couple things with you that caught my attention as you guys are asking me questions. So I'm going to see if I can't have you think as well. All right, historically, what happens the first trading day after the end of a month? There are 8 of you, there are 18 of you. So historically, what happens? What happens the first day of a new trading month? You guys tell me. I don't want to give it away, but you guys tell me what typically happens the first day after a new month. It starts with the 1. First trading day, not necessarily true. This is a 6 for us. So I want you to get thinking trading wise, right? We know what happens at the end of the month. What happens at the first trading day of a new month? So what was the first trading day of a new month? Let's do it that way. I got you guys, huh? Okay, so let's reverse this. What typically happens the last trading day of the end of a month? It goes down. I like where your head's at there, Lance. Why does it go down? Why does it go down? Lance, I want you to think, why does it go down the last trading day of the end of the month? There you go, perfect. Rebalancing happens usually the last few trading days of the month. Perfect. Reverse it now. Historically, what happens the first trading day of a new month, like today? Okay, Lance, you already answered. I want someone else to answer. Abraham. William. David. Dave, you already answered. Jim Kohler, what happens the first trading day of a new month historically? I see it over and over again as I do fees. Kind of get screwed that last day. New money comes in. Perfect. Love it, Jim. Need to pay new bills. Not quite, Abraham. I don't know if the market has to pay new bills, but historically, new money comes in. So here's my question. So what happened today? No real earnings reports. What happened today? We're as high as almost up 0.5%. So the range, I'll take that, was roughly up 0.5% and down roughly 0.55%. finishing at 0.41. So what happened today? Boy, I'm really getting you guys to think. This is good. So what happened today? Okay, I'm going to give you a hint. Better than expected ISM services index. It's usually called, well, they now call it non-manufacturing, but better than expected ISM services index came in at 56.9 versus an estimated 55.2. What else came up today? Or what was moving today? Wow, William, that's neat, but I want to know where you got that. GDP here in the US looks to be 2.6% percent for the quarter. So we might not have the 3 months in a row. I read that article, but I don't remember where I saw it, so I can't put it in there, William. But just thinking out loud. That's what I'm looking for. David, perfect. That's exactly what I was looking for. And trying to say that. So the short answer is yes. New money was coming in today to keep us from falling down another 1%. I would agree. I would agree 100%. Yes, we do have a new prime minister. Out in England. In fact, William, you should have said that. I forget what her name was, but she's going to take over. Any other thoughts? Any other thoughts you guys have? Just a little bit. Okay, so I'm going to throw this out. Our markets are approaching the oversold area. So that's where the big question is going to be. The Dow, still bearish. We're looking really good at hitting the pivot point of last month, but we'll probably still go down to that 30,588, which will just get us touching the oversold. Last time, little bounce up, bounce down, and we kind of moved higher, right? Excuse me, that's not the last time, February. Little touch in May, little bounce up, went down lower. Double bottom touch in June, bounce up, bounce lower, bounce up, bounce down again, right? So in some way, shape, or form, for looking at the Dow, we should see a little bounce coming up here in the near future. If we follow the S&P 500, once again, we're looking at exactly the same thing. Just about touching. We went into oversold in January, hit it in February, bounce, almost came back down, struggled, and then went higher. We do have a touch here, which we need to count, little bounce. Then we really went down lower. Little bounce, then we went down lower. Little bounce, then we went down lower. So again, our little bounce, if we're looking at a chart, and it's not historically accurate that it always follows it, past performance never guarantees future results, but we are looking at a little bounce, 3,900 to 4,020. That little bounce could be up to the 50-day, and then we will probably head lower. Someone tell me, what's the trigger to head us lower to go retest those lows at 36 this year on the S&P 500? Anyone know what is that trigger that'll cause that area? So expecting little bounce, then lower. And what's the trigger? There you go. Fed September 27th, and I believe it's 27th. Yeah, it's probably the 28th. Rate hike meeting. And we're already told it's another 75 basis points. There's some talk that it might be less than that, but yeah, the expectation is .75 rate hike, which my opinion means, once again, the Fed overshot the mark. Why did they overshoot the mark? Because it is supply and demand driven, not inflation driven. It's ridiculous. It's absolutely ridiculous. I truly do not understand what's happening. So that brings me to the next question. So if you truly don't understand what is going on, what do you do? Really, if you truly don't know what's going on, what do you do? What do you do? What is going on here that you would look at and be like, hey, something's not right? What do you do? And it's funny because, well, actually, I'm just going to let you guys make the comment. Yeah, definitely. You protect, right? As we go back and take a look one more time, and Babu, I don't know where you came in at. Our expectation going over what we already saw 1, 2, 3, 4, 5 times, right? Little bounce up and then the bounce lower. Little bounce up will probably be to the 50-day. Then we'll go and retest those downside. Expectation. It's really interesting, right? Because again, some of this isn't considered life or death. You protect, you research the heck out of what you don't understand, and you get a game plan ready. And that's what you're looking at. That's what you're looking at. That's the decision to make on what you're going to do. And it's hard. It sometimes doesn't make a whole lot of sense. And our market doesn't make a whole lot of sense right now. In fact, I found some really interesting articles that I just wanted to throw out here. Why it shouldn't be as bad as the 1970s. The 1970s, I'm going to say even up to 83, inflation was outrageous. Some of you may remember, I don't, but inflation on homes in the 18% range, paying 18% interest on the purchase of a home. Jim, I'll answer that here in a second. Should our inflation be as bad as in the 70s? Probably not. But if you believe Karen Gilchrist, which I don't know who she is, it could be interesting. I disagree with her. I disagree with the way that she goes through things, that the fallacy of a global crisis. I know what she's trying to say, but the short answer is an interesting article on the inflation. No, it should not be as bad as the 70s, but it has nothing to do right now with war. It has nothing to do with the inflation, as our inflation is relatively tame, the supply and demand is not there. And it most definitely is a global crisis. A better article, don't expect the S&P to make much progress with rates this high. A really, really interesting article that goes back to that's trying to make a comment on where we could end up was right here. And again, this is the, I don't know, this is the understanding that justifies the 3,600 down level to possibly 32, but maybe not getting above 4,300 in the near term. It's really an interesting look at someone that's done some research, that's looking at past lows and past highs and trying to help find out where we end up. I even had another article. I do have Goldman's talking about encouraging signs that the economy could still achieve a soft landing. If I was to ask you guys, are we in a soft landing right now? Would you call this a soft landing? So it's interesting that you said that, William. And you're over in England right now, so it's a softer landing than some areas. I'll give you that. That's an adequate statement. Jim made the comment, isn't the Fed kicking the can down the road, though? Not necessarily. The Fed, when you're looking at the Federal Open Market Committee, is not. They're tightening. Is the federal government kicking the can down the road with how they want to lighten taxes on gas and how they are going to do a education grant and loan give back of up to 20 grand, it looks like, to people? Yes, but the Fed, not necessarily so. But again, are you guys feeling a soft landing right now? Knowing, yes, it could be worse, but is this soft? Or so Dave makes the comment, it feels hard, but it could be harder. And yes, that is obviously what you should be looking for, looking about, right? It does feel hard when you have 100% increase in gas prices. That's rough. But it is interesting. You haven't really seen 100% gain in profits in the oil industry. Not here. In fact, with less, so just to help you understand, with less barrels that we're able to produce, with some opportunities or drilling opportunities to get shut down, with shipping costing more, with a pipeline getting shut down, they're not going to make double. Just because the price is double doesn't mean that you're going to see the profits in the oil double. In fact, most of them are only up about 10% from the rise in the price. But again, is this a soft landing? Great comment. So that's interesting. In fact, Mary, glad that you're here to join us. And that really is where I was trying to go. We don't know if we are in a hard or soft landing yet. 100% correct. We don't know. So it's not part of the guessing game. What we do know on the S&P 500 we should expect a short-term bounce. A short-term bounce to probably the 50-day simple moving average. That would coincide to the other 4 or 5 bounces we've had. And then we should expect to go lower. So as we're seeing things going back to the 50-day, that's where we're going to try to protect a little bit more and put some short calls on to help make up some of the downside movement. It's also where we'll probably stagnate or add a couple extra contracts for puts on the way down, so we can start to make up more than the stocks are losing. And that's our general game plan, knowing we've got about 3 weeks until we're going to have another Fed rate hike decision. And in those 3 weeks, we are going to do the best we can to almost overprotect for our Fed meeting. That's kind of where we're at. Now, I'm going to make one other comment. If you don't know what's going on and you can't calculate a bottom or reasoning for a fall, you shouldn't be in the market. You don't have to be right. You don't have to be right. But you do have to be able to explain what you are doing and why. And it doesn't get any simpler or easier than that. Any questions? Yes, it's a historical pattern that the first trading day of a new month, new money comes in, new money gets put to work. And the last day or days of the month, you typically will see money go out. So those are the pretty standard outflows and inflows that are related to rebalancing. So Kevin, what you're telling us is you're guessing. And the short answer is I'm making an educated guess, looking at past history in our charts, knowing that past history obviously doesn't guarantee future results, but I'm taking the most recent information that we have and I'm creating my game plan for what we're doing. The good news is where we started adding protection for just about all of our core holdings. I guess I could do it right here in our chart, right? Where we started adding protection was on right here. And for 3 days, hey, have you got it wrong? And then nope. So we literally started adding protection when the 4,200 break on the S&P occurred. That was our rough line in the sand from where 4,200 had been support and resistance ish in that time range in that area. And yes, some of you guys question me, Kevin, are you outguessing for 3 days You guys are like, why are you adding protection? Earnings are over. What's going on? The markets are going up. And the bottom fell out. That same little dip and drop, we see it here on the median line. We're looking at that same thing for oversold. And we have been oversold already, and chances are it's probably going to fit back to our January oversold where we lose another 5 to 7% as well, as rates take out as rate hikes take out the opportunity for companies to borrow at the relatively cheap prices we've been used to for the last decade. Interesting comment was just made by Jim Kohler, so I don't know. Should we be concerned with the new ideas that got us into trouble in the 80s and 2008 mortgage crisis? No money down for mortgages, over leveraging, and overspending. Bank of America seems to want to go down that path, and others will follow. A lot of similarities starting to appear. It's interesting because home prices are definitely way overpriced right now. In fact, we all should have sold our houses 3 to 6 months ago, right? I have an interesting article here about we're in a housing recessions. Here's what owners and sellers should buy. It's really good that homeowners are in a comfortable position that their homes are worth quite a bit, right? That's the short answer. What I did like about this article, and again, I don't know Sarah O'Brien from anyone, sellers need to be realistic. Sellers need to be realistic about the changing market. They cannot expect to simply list their homes at a high price and easily find a buyer. Too many buyers are chasing too few properties. Those days are over, he said. With that said, homes are still selling really quickly. And I could still get a really good price for my house right now. We're just thinking, though, this is where we need to be. In fact, if anything, we might need to use some of the equity on our house to pay off some of the bills that we're coming into with Jared's accident. And is the long answer there. That is just where we're running into some worries and concerns in regards to, hey, taking out a home equity loan might help us out with having our house worth, 4.5 times the value of the mortgage that we still have on it. So pretty interesting. This was a local article, but I like the premises of homeowners in a very comfortable position. Buyers may encounter a more balanced market, and sellers need to be realistic. Very interesting article. Since we're down here, I found it interesting. These are Wall Street's favorite defensive stocks amid September's reputation for market losses, right? September's the third worst month. October is the worst month in the stock market historically. They put these stocks in here because of their dividend yields. AES. AES is a utilities company, already at their yearly high. I would find a hard time investing into that one. ETR, utilities, again, energy. It's another energy stock, a utility stock, that's all I'm going to say. Aviv. Here you have a healthcare, drug manufacturer. I don't know why you wouldn't go to something more stable than this one, a Merck, a Pfizer, but apparently this is one that they felt. PEG, the public services, again, another utilities company. CVS is healthcare and retail. Mondelez is consumer defensive, and they are down at their lows, and then Target's a retail. So I found it interesting that this would be their core holdings. I could see the utilities going into winter with natural gas being higher. I could understand that, but I don't know. I mean, when you're picking utilities, I wouldn't choose a yearly high, and I wouldn't choose a low. I don't know if I would choose retail for CVS or Target for that matter. Mondelez, consumer defensive, I understand. Intenergy, public service health enterprise group, those make sense. I mean, I'm looking at it, and it's like, man, I kind of understand 2.5, maybe 3 of what you're doing. But I found it interesting that that's where they were pushing some people to. Maybe some of them, they're going for the dividend yields, 2.4% on AES, even though it's at a yearly high. I don't think 2.4% protects you from a drop. Entergy, 3.5, pretty good. Aviv, I mean, healthcare, drug manufacturer. I wouldn't be in them even with the 4% dividend. Public Services Enterprise Group, I definitely 3.2, that would be a good one. CVS Retail, 2.2 doesn't help me when they've been down at the $58 range. It just is kind of worrisome. Mondelez International, consumer defensive, 2.3, maybe. Target, do we not remember how far they fell? 35% after an earnings. Might be a good play into Christmas, but I'm not sure I see that big defensive part here that I would be considering going into those. All right. We're bearish, but almost over sold on all 3 indexes, so do expect a little bounce. End of September, I'm still saying 2%, but it would not surprise me to see us down 5 to 7%. Earnings, not much going on. GameStop on Wednesday, DocuSign on Thursday, Kroger on Friday. Economic reports, trade balance tomorrow. Really through this week, consumer credit will be important for us to see on Thursday. It was kind of nice to see for a while, at least this morning. MasterCard, Visa, Discover Financial Services, they were all up, and they were all up today to end the day out. So it was nice to see that finally people are saying, hey, people are going to go back to credit when they don't have enough money. Kind of common sense. Wholesale inventories will be interesting, but not a game changer on Friday, just to see if we're building up the inventories that we need for Christmas. And I think I only had one other. I already talked about the inflation article, the S&P 500 progress. I did put an article of the screw ups that Ford has announced with their new electronic vehicle. Again, proof that it's not best to come out there first and quickest. An Apple approach to make sure all the bugs are out would be better. Good reason why Ford's going down. And I just put it in here out of curiosity. 10 of Warren Buffett's funniest and most frugal quirks that he has. Never spends more than $3.17 on breakfast. Always eats at McDonald's, basically. He drinks 5 Cokes a day. That seems like that's a little high. He lives in the same home he bought in 1958. He has instructive art hanging on his office walls, which I find very interesting. I've got a boy that actually has a journal of mistakes he does in soccer, whereas he has copies of some economic crises just to put you guys into the understanding of what could be ahead. I don't know if you most recently, the Bed Bath & Beyond from 51 floors decided to jump out his window. So here we have people jumping out their windows again and committing suicide on financial woes that are occurring in the market. Not a really good thing to do. He's been in the same office building for more than 50 years. He doesn't keep a computer on his desk. He reads about 6 hours a day. I don't even read that much. I'm probably closer to 4 to 4.5. When he's not reading, he's thinking or playing bridge. Definitely thinking or doing calculations. I don't play cards or bridge. He once had a vanity license plate that read thrifty. I like that he stayed with it over the year. Despite his billions, he's a careful investor. He still uses coupons. Just some interesting things I thought I found out on Buffett I wanted to put out there. And other than that, I think I've gone over everything I wanted to go through today. Any questions that you guys can or would like an answer to? Russ, you came a little late. I will post this on myhurleyinvestment.com. Again, myhurleyinvestment.com. The first 20 minutes, I had some really good stuff. So I'll see if Dave can't get a hustle on getting this up and posted. But question. So what are you doing in your own portfolios? I'm sitting just like you guys. We've got protective puts on everything. I do have some leap long calls that we're condensing down and looking for more time in them. And that's about where I'm at. Yes, I still have Ford $17 leap long calls. All right, guys, as you know, questions coming in. Guys, take care. Have a wonderful evening. Pleasure being with you as always. Hopefully enjoyed your Labor Day holiday yesterday. We will look for Thursday. Key will have some type of trade findings and adjustments, and we will go from there. You guys take care. Have a good one, and I'll see you next Monday. Good night, everyone.